I'm Charlotte McLeod with investingnews.com, and here today with me is Patrick Tuohy, Global Head of Sales and Marketing at Goldstrom. Thank you so much for being here. Great to have you.
Pleasure, absolute mine.
Really good to be speaking with you. We've got a lot to go into when it comes to gold and silver, especially with the prices doing what they are right now. But before we start jumping into that, I wondered if you could give a brief overview to yourself and your background in the sector.
Yeah, delighted to. I think I had an unusual introduction into the gold space. Most of my career, 45 years, has been in financial services, principally capital markets, asset management. And I sort of retired, I guess, semi-retired probably a decade ago. And it seemed like a good idea. Someone presented me with an opportunity to finance a gold transaction. And in the process, I managed to successfully lose all my money in the trade. And but I'm a firm believer that everything happens for a reason. And in that process, I was fortunate enough to meet a young Australian trader called Nick Drapak. And Nick is the founder and the principal of Goldstrom. We became friends a decade ago as he tried to recover. So I had a very expensive MBA, I guess, into the business. And that was, some of the challenges of trading in the unrefined markets and the upstream markets. Nick and I became friends, and probably 6-7 years ago, we sat down and started to pencil out Goldstrom. And 5.5 years ago, we came into being. We had another fantastic piece of timing. We set up in Singapore on the weekend of lockdown, my birthday, March the 19th, 2020. And that was, again, an interesting place to start. But I do believe that all of these things do actually happen for some sense and reason that are usually apparent many years down the line.
I always love to hear about how people come into this sector. And you're right. I think everything does happen for a reason. So we'll get into what's happening with gold and silver and Goldstrom. Let's take a look at gold and silver prices first. Of course, we know that they are on the move right now, trading at or near all-time highs, depending where we are at the moment. I'm wondering if you can break down the factors that you see driving the metals right now.
Yeah, I think there's probably two key elements to this. I think one is the long term. If we take the very long term, and it was interesting before we came on that we were talking about 2011, 2012, and I think since the turn of this millennium, there's been a change of narrative in terms of gold, and I think there's been a reestablishment of gold from being a very out of favor asset, unloved, to being an asset that at the highest level, at the central bank level, was perceived as a necessary store of value, to then being seen as a store of value. And I think that really we're just sort of progressing through that now the let's say the investing community have woken up to this narrative. And I think that's been happening in the last 2, 3, 4 years. And that's sort of where we are. So I think the long-term narrative, gold has reestablished itself as a store of value and perceived store of value to everybody. I think actually gold has possibly separated itself from other precious metals as being almost an allocation in its own right, with other precious metals sitting around it. So that may or may not be the case. But in the short term, I think, the obvious reasons are out there. There's been central bank buying, which is somewhat supportive of that narrative, but that's been driven, in my opinion, by de-dollarization. I think the emerging market central banks just trying to play catch up. If you look at the Europeans in terms of the volume of foreign reserves they hold in gold, it's north of 50%, 50 to 60%, whereas the Asian and the Central Asian, the South American central banks hold significantly less, and they are the key buyers. So that's supporting. And I think every time we see any sell-off in the market, typically at London fixing, there's a pickup, and that's usually a central bank stepping in, I believe, to take that value. Then I think there's just a growing. I don't want to sound too pessimistic, but I think there's a global lack of trust. And I think that is cascading now into gold. I think a number of people are clearly on the gold wagon just because of the price. And I think that's the inevitability of it. When you get in a taxi and your taxi driver tells you about the current all-time high for gold, you know that you sort of reached that point in the cycle. But I think we've certainly changed the narrative and the dynamic for gold. And then as a consequence, the other precious metals follow along behind.
That's exactly the direction I was hoping to go in with you. Is where are we in the cycle right now? Are we at that point where the taxi driver is talking to us about gold? Because I see people getting quite excited to see what the prices are doing, but there is a sense of wondering, all right, well, does that mean that we are close to a top here? So I'm wondering how you see it.
Yeah, that's the question I think no one truly has an answer to. But is this a short-term phenomena that's going to have some dynamics that are going to turn it on its head and it reverses 50, 60%? I don't believe that is the case. I don't believe that is the case. I think within our group, and I know you've met one of my colleagues, Jeff Rhodes, the consensus is that it's unlikely that we'll see gold below $3,000 again in our lifetimes. So, let's say that's the floor. That's a fairly significant move from where we were 2 years ago. So, that's comfortable. I think gold has, if you look at the long-term performance of gold, certainly in this century, you're looking at 10 to 12% type returns. And I think that is not an unreasonable expectation for clients. Maybe in a very, very low inflation environment, you'd be nearer 8 to 10. But in the environment that we're in at the moment, 10 to 12 doesn't seem like an unrealistic number. And maybe we've got a little bit ahead of ourselves at the moment. There's a bit too much froth in the market. And that's just the inevitability of investing. So I don't believe that gold has peaked and this is an all-time high and sell. I think this is just part of what we need to accept is the inevitability going forward.
Of course, impossible to know for sure, but all of that sounds quite reasonable. And I want to talk a little bit more about trends you're seeing in terms of who is buying gold. I know you talked about what's going on at the central bank level, which countries are doing the purchasing at this moment. What are you seeing among customers? What kinds of conversations are you having right now?
Great question. I think there's two types of investors that we see. In that there's the traditional gold bugs who've always been in gold. They love gold. They will always be in gold come hell or high water because they see gold as fulfilling that insurance policy aspect of their investments. It's the ultra rainy day money. It's there. It's outside of the system, and it's the foundation of their portfolio and their investment. I think I don't want to be disparaging, but let's say the come latelys for gold are people that are looking at the price, and it's sort of demonstrated, phenomenal performance returns this year and pretty damn good last year. So I think there's people jumping on it from a price perspective who maybe don't have the same emotional attachment to gold and don't necessarily understand the true benefits of, say, a physical holding versus a paper holding. So I think the inflows into ETFs this year have been significant. I think that's a key lead indicator. Clearly, when the price is this high, the traditional jewelry community that suck up 50% of annual production, they've been slightly sidelined or maybe diverting their attention into silver and platinum. So that's been a driver of those metals, I think, to a degree, India and China. So the new investors, I think, that there will be an inevitable fallout, because there will be some people who have bought gold in the last 18 months and actually believe that gold goes up 30% a year. And as soon as it stops going up 30% a year, there'll be sellers of gold, because all of a sudden it won't be the sort of gold is the next crypto for a number of people. And that's sort of frightening, but that's an educational factor. So the conversations that we're having are typically around paper versus physical. Should I be buying an ETF? Should I be buying physical? We sit in very much the traditional camp that physical is gold, and unless you can take delivery of your ETF, then you have a promise. And if the reason that you've bought gold is trust, well, you seem to be sort of circling back and eating your own tail, really, in that respect. So the conversations are, should I have physical? And the answer, we believe, is obviously a resounding yes. That brings some complexities with it. So there's some educational conversations that we're having with both private clients and the distribution world that we work with. So we're having to educate them on the benefits and the protocols that go with owning physical. So that in itself is a process, and maybe a lag into people taking exposure. So that's not a bad thing. We've established or in the throes of finalizing the establishment of an academy, actually, which is there designed to train the intermediary market and the private client market, if they're so inclined, into the whole supply chain of precious metals, to sort of walk them through that journey. Because even though it's the oldest asset class, it's probably the least understood. And again, I'm probably showing my age here, Charlotte, but we sort of live in a world where everything's got to be done in clicks or 125 characters. So when you actually have to open an account and fix a price and then take physical delivery of something, it just appears a lot more clunky to people today than just pressing a button. So there is that sort of education process that we need to come over. I think one of we'll probably get onto it in a second, but one of the key areas that we're trying to educate the gold bug market, the established buyers of gold and precious metals, is really around utilization of gold. But I'm sure we can come onto that in a while.
Very interesting. And I want to ask a little bit more about strategy as well, because I was mentioning to you, our audience is pretty exposed to precious metals, some experience in that sector. But questions that I'm seeing in our YouTube comments, for example, are, well, should I be rebalancing my portfolio and look more at silver and platinum, for example, at this time? So anything that you can say on that note that might be helpful? Of course, every person is different.
100%. I think that is really the narrative. I think people need to, it's like anything that's new, any activity that you have, you've got to get some basic element of mastery. And I think owning gold, it's 85% of the market in terms of daily volume. It's the safe place to start. And it's the place that people should start. Once they get comfortable with that, then we can start to have the conversations about the nuances and the differences between gold and silver, and why we've been buyers of silver for our let's call them our bug clients for probably 24, 36 months now. We bought into gold very early on. Bought into silver very early on, and felt that this was just, a catch up that needed to happen. And again, we see in the near term an outperformance of silver versus gold, because we're still only at 80 in terms of the gold silver ratio. So we believe that we've got quite a bit to go on a normal mean reversion. So we start the conversation by getting people comfortable with precious metals, the process for owning them, and the costs, the considerations. But then the conversation absolutely must extend to silver, and that would be where it probably stops for most of our clients. So we offer a service to clients where we will provide a monthly rebalancing, and it's more of a monthly conversation with a quarterly rebalancing. And if you're in physical, the cost and the logistics of just trying to move a portfolio around on a weekly or monthly basis, it just doesn't work. So it's a far slower moving. It's more like probably like rebalancing a S&P ETF, something of that description. And we will basically move those allocations around, again, taking into consideration the risk return profile of the individuals that are there. We don't have a crystal ball or a magic view into the future, so we don't know with any absolute certainty what the price movement is going to be of these assets. But we do feel comfortable that in the near term, silver will outperform gold. And if you're prepared to live with that volatility, and there will be volatility as a consequence, then that's an appropriate thing to do. So typically for a more aggressive investor, we may be as much as 25% in silver, 75% gold. The more balanced clients are today hugging, well, I would say they were at 15, and the price movement has probably taken them nearer 20 of their portfolios now in silver, 20%. versus gold. Platinum is really sort of out there. Again, it's a thin market. It's whatever it is, 1% of daily volume. So it's a thin market that brings with it volatility that, in my 40 odd years of working with investors, the volatility is probably your biggest enemy, because it's the thing that spooks people. And you can start with a sensible investment strategy, and you just need a bad 3 or 4, 5 days of drawdowns of some proportion, and people believe the world's come to an end, and all of the principles that they had in terms of investing get thrown out the window. So platinum is there for, I think, it's sort of the mastery. I think when you've got to sort of black belt of precious metals, then platinum would be a conversation that we would have. But we are absolutely encouraging investors, once they're comfortable, to have some silver in their portfolio, and in varying amounts.
I think that makes a lot of sense, the way you're laying it out there. And I want to talk a little bit more about some of Goldstrom's offerings that might be interesting or unusual to people, which are interest on physical gold and credit lines against gold. So what can you say about that and how that works?
Sure. So our business is, I don't want to say unique, or that it's unusual in as much that we operate probably in the wholesale market. So we're not really a gold broker in the traditional sense that, we don't sell gold online. We're not in the business of selling kilo bars or coins in the B2C space. So we very much work with other traders, and we work with more institutional, high net worth. I'd say our average client is probably sat on 25 kilos of gold. So that's the sort of the quantum of sort of entry point into Goldstrom. So for those clients and the gold bugs, this has been an interesting journey. So we look at the bullion banking world, as a number of our colleagues have come from that space, and see that gold is an asset that's utilized. It's an interest-bearing asset at the institutional level, at the bank-to-bank level, central bank to central bank level, and there is a demand for gold in the jewelry segment. So the jewelry sector has been probably the most affected by the rise in price of gold, and not in a positive way, over the last 18 months. So as gold shot through 3,000, there is a psychological, wow, this is expensive, and gold jewelry sales tend to taper off. But the thing in the background that's hurt the jewelers the most has then been the financing that they have of their stock, because those credit lines that they have from banks, those facilities that they have from traditional lenders, are almost always in dollar terms. So they are limited to a certain amount of dollars that they can actually borrow. Now, if the price of gold has gone up by 20 or 30%, then the amount that they can borrow is reduced by 20 or 30%. It's a zero-sum game. So leasing gold to a jeweler removes that friction, that challenge that they may have with either putting up more margin or reducing the volume of facility that they have, the size of the facility that they have. And we've sort of crossed the Rubicon with a number of investors. If I could just take a step back, I think traditionally people that have gold and they have it in a vault have it for that emotional reason of being outside of the system and actually wanting to know that they own it, they can touch it, they can go in at lunchtime and see that it's there and feel comfortable with it. And we believe that is, 100% solid as a rationale. However, if they want to actually earn interest on this gold, there is a market that will lease this gold from them. They won't borrow it. They will lease it. And there's a very subtle difference in as much that you're not giving up titleship. You're not giving up ownership of your gold. You are transferring the use of that gold to a third party, a jeweler, who's then able to use that gold for a period, typically 12 months. And at the end of that period, will return the physical gold to you. In that interim period, they will pay you interest, and that interest will also be paid in gold. So your gold will be credited to you in ounces or grams. So what we've done is we've created an ecosystem where, and this is something that's been ongoing in the Middle East for nearly 2 decades. This is the way that financing is largely done in and around sort of Dubai, UAE, Qatar, places of that sort. So this isn't something that's new and something that Goldstrom has sort of hatched as a plan. This is just bringing something from another jurisdiction to the modern world. So we're able to offer those people that have gold in a vault, if they can get to the comfort level of having that gold deployed and the collateral managed by us, the ability to earn, anywhere between 3 and 4% on their gold as a return. So that, for many, does change the dynamic. Now, where I would say we were talking about the 2 types of investors, the sort of the gold bug and the come lately. The come latelys are actually finding this much easier to come to terms with than the gold bugs. The gold bugs are there saying, well, no, if I lease my gold, it's no longer mine. Yeah, I appreciate I've got title, but it's in someone else's hands. And then we further compound matters for them because that gold gets converted into jewelry. But I'll come on to that a little bit later. People new to the space look at gold and think, yeah, this is interesting. But actually, if I could get a yield on it and you can offer me what we call gold plus, an ETF plus a return, then I'm really interested. So all of a sudden, we're not talking about buying an ETF. We're talking about buying something that's going to give you an ETF plus the yield and, minus some fees. So net, you're going to get more than you would from an ETF. So that's sort of number one. Second part of your question was around credit lines. And I think the repo market is well established in the bullion space. I think seasoned investors will understand the repo market. And you've just got to get comfortable with counterparty risk. But we're able to offer people liquidity against their gold with guaranteed buybacks. So we know that effectively, yes, technically you lose title to your gold, but you're actually in the market. You're still long gold. So you're taking some liquidity. I wouldn't call it taking profit off the table because you stay fully exposed. So you're taking some liquidity against the returns that you've had, deploy it somewhere else. I spent 20 something years in the hedge fund space, and leverage was always to the uninitiated was the devil incarnate. However, if you use leverage in a sensible way, you can actually help yourself diversify. And that's really where we put credit on, or credit lines on gold as I suppose, not to leverage up gold, but to diversify maybe into silver.
Well, I think that gives a pretty good look at what Goldstrom is doing, how you see the market. I will let you go unless you had any final thoughts that you would leave investors with right now. It's pretty interesting times.
Yeah, I think it is interesting times. We're living in history. And I think for me, the transition, the destruction of trust that I think we've seen in the financial markets. I've been in the markets long enough to know that this isn't a new trend. This has been going on, and the whole global debt position has been something that people have been talking about, and it's going to trip us up at every moment. And as we always say, a stock clock's right twice a day. So sooner or later that will come. And we had 2008. But I do think this time it's different. And I know that's always a dangerous thing to say, but I just think with global trade, and I just think the sort of the global repositioning that we're going through, not necessarily driven by geopolitics, but I think driven by trade, is that we are actually seeing, quite a partisan world forming up. And, is China ready to adopt the mantle of being the global reserve currency for now? I think probably not. But I think when you look at what's going on in this part of the world in terms of Shanghai Gold Exchange, starting to vault metals in Hong Kong. How far are we away from a renminbi futures contract in Hong Kong in terms of that? How far are we away from a clearing system in Hong Kong with that bullion being traded unallocated, styled Loco London? So there's lots of interesting things, I think. So we are living through history. And if I was an investor at one end, would I be concerned that we're at an all-time high? No. Equally, if I'm coming to the market brand new today and I had $100 to invest, would I rush in with all $100? No, I'd probably stage that over a month or so. I think that there's an opportunity to just sensibly dollar cost average. But this applies to all assets. It's not just to gold. That's just investing common sense. But I do think that we are living through history, and maybe, our children, grandchildren will look back and talk about, the 2020s as the year when the world flipped and gold and precious metals sort of resume their status as the international core assets. So, yeah.
It feels like that could certainly be true. Well, thank you so much for coming on to go through what's going on in the precious metals. This was really great.
Pleasure, Charlotte. Lovely to see you. Lovely to meet. Take care.
Of course, you as well. Once again, I'm Charlotte McLeod with investingnews.com, and this is Patrick Tuohy with Goldstrom.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.